So in this video, I'll be answering some of the really great questions that I've been getting from you guys lately. We're going to go through a handful of these to see if we can shed some light on the things you want to know the most, starting with this question here from Cyclone Craw X on YouTube, who asks, if you had to pick only 3 stocks to hold for the next decade, what would you choose and why? So this is a really tough question to answer for a couple of reasons. First, it's going to be really hard to narrow this down to just 3 stocks. There are obviously many great companies out there to choose from, but to make it easier, we'll just stick within the realm of my own portfolio. That's probably going to be the best way to approach this question. And second, obviously it's impossible to predict the future. I have no idea what these next 10 years are going to look like. And because of that, I think I'll approach this by considering the stocks that I think are most likely to survive whatever could possibly happen over these next 10 years. If for some reason the stock market were to close and I couldn't make any changes to my portfolio over these next 10 years, which stocks would I want to have locked away? And here are my 3 picks for that. The first one, guys, is going to be Visa. And we talked quite a bit about Visa in one of my recent videos. In my opinion, it's like the gold standard of stocks, but Visa is the largest payment network compared to others like MasterCard or Amex. And as time goes on, people will use cash less and less to pay for things, which only stands to benefit Visa. I think the transition more into digital payments will continue over these next 10 years and would even continue if the stock market were closed this entire time. And I think my position in Visa, of which I have 20 shares, will be worth more 10 years from now than it is today. But anyway, moving on, my second pick, guys, would be Procter & Gamble. I love this stock, and over the next 10 years, I have no doubt that people will continue using necessities like toothpaste, toilet paper, laundry detergent, deodorant, and all the other household essentials that Procter & Gamble makes. As a result, I think Procter & Gamble will be a pretty safe hold over the years, and I have a hard time seeing their 65+ year dividend growth streak being in jeopardy over the next decade. And then last but not least, believe it or not, my third pick would be Chevron. It seems to me that the transition to renewable energy sources will be a multi-decade process, and in the meantime, energy demand only continues to grow and will likely do so over the next decade. I think this serves as a strong tailwind for companies like Chevron as well as others in the industry, and I think it will continue to be a reliable investment in the coming years. But anyway, those are my 3 picks, and now I want to throw it back on you guys. If you had to pick just 3 stocks to hold over the next decade and you couldn't make any changes to your portfolio, which ones would you choose? And you can't pick any ETFs, that's cheating. So let me know your 3 picks in the comments. But anyway, guys, moving on to question number 2. This one comes from Gavin Grant. And Gavin wants to know, what do you think of a young dividend investor going more risky? I'm looking at stocks like ORC, AGNC, and PNNT. So first and foremost, in case you're not familiar with any of these ticker symbols, these are all higher yielding investments. And while I understand the draw to high yield dividend stocks, believe me, I totally get it. I think you should stay as far away from these stocks as possible. I don't think investing in these is a good idea at all. I think it's only natural to want the most amount of dividends in the shortest amount of time and with the least amount of money invested. Like I said, I totally get the thought process behind it, but stocks like ORC and AGNC are certified yield traps. And just to give you some more insight on what I mean by that, let's start by looking at AGNC. So we're over here on Seeking Alpha looking at the dividend stats, and if we scroll down, we can see that AGNC has an incredibly high starting dividend yield at 14%. That dividend yield is definitely very saucy. But guys, you got to be careful with these high yield dividend stocks, especially ones like this that have a negative 5-year dividend growth rate. We can see that on average over the last 5 years, AGNC has reduced their dividend by a rate of almost 7.5%. And if we jump over to the dividend history page here, we can get a little bit more insight on that. I mean, just from looking at this chart here, we can see that over the years, AGNC has been a notorious dividend cutter. It has been stable since 2020, so for the last handful of years, I will give them that. But prior to that, and overall, AGNC has done nothing but reduce their dividend. So just because of that, this is a stock that I would personally choose to stay as far away from as possible, no matter how high the yield is. But anyway, looking at one of the other examples, ORC, which is Orchid Island Capital, it's going to look pretty similar. Their starting yield is even higher, closer to 17%, so that's definitely a tempting dividend yield. But you got to look beyond the yield, guys. Once again, if we just mosey on over to that 5-year dividend growth rate, on average, over the last 5 years, ORC has reduced their dividend by 20.3%. That's insane. And as we can see, just looking at the dividend history chart, they're an even bigger perpetrator of reducing their dividend than AGNC. This is not good. Once again, this is not a company that you'd want to invest in. And if we zoom out a little bit more on the chart, we can see that it's not just these last 5 years where this has been the case for ORC. They've been doing this over the last decade. Now, in the case of both of these companies, I mean, as we saw, they have incredibly high dividend yields. That's definitely very tempting, but the dividend per share is going in the opposite direction of what you want to see. At the end of the day, you want to invest in companies that are growing their dividends over time, not reducing their dividends. You don't want your income to go down. So look for those dividend growth companies, even if they have a lower starting dividend yield. Consistent dividend growth is a sign of a company's financial health and stability, and this growth aligns more with the fundamental goal of dividend investing. Once again, you want your income to be going up over time, not down. So skip the yield traps. But anyway, guys, moving on to question number 3 here, which comes from my friend Zero to Hero Investing, who wants to know, how do you balance investing goals with personal life/carefree spending? So balancing investing and carefree or discretionary spending is a really tough thing, and a lot of people struggle with this. Actually, Russ and I were talking about this exact thing like just last week. The way I see it, investors are typically on one end of the spectrum and prefer to sacrifice spending today in order to put more money into their portfolios for the future. They have their sights set on reaching financial freedom, and many investors find this trade-off to be worthwhile. And they get a lot of enjoyment out of investing itself. It's a fun hobby, so it doesn't really feel like a sacrifice. Now, on the flip side of that, people who aren't interested in investing might focus more on the present with less regard for the future. Because of that, they may be more likely to spend most, if not all, of their extra money on things and experiences today, preferring to live in the moment because tomorrow isn't guaranteed or something like that. Personally, I think both mindsets have their place. Ideally, you should be able to enjoy the present while still being mindful of the future, and striking this balance is a really tough thing, but I think the key to doing so is through budgeting. In my personal financial situation, I automatically contribute a set amount each week into my portfolio that's already budgeted in, and this amount is something that's comfortable and sustainable for me, and then my remaining funds that don't go towards expenses are available for other saving or spending, if there is something that I want to buy or spend money on, which for me is not really a regular occurrence. Truth be told, I'm just inherently not a big spender. My hobbies outside of investing are things like weightlifting, reading, love reading a lot, and even making these videos is a hobby of mine, and these are all pretty affordable hobbies that don't really cost much, if anything at all. And since I don't have any sort of spending problem, it's pretty easy for me to save money, and since my investments are already automatically taken care of, I don't feel guilty about any occasional indulgences whenever they do occur. Overall though, I think it's important to structure your personal financial situation to make sure that you're having your vegetables before dessert, if that makes sense. And what I mean by that is, make sure your bills get paid, okay? Make sure that you have cash set aside in case of emergencies. Make sure that's taken care of. Make sure that your investments are taken care of every week or every month, however often it is. And if you're able to balance all of those different things and you have some fun money left over after all of that, then that's fantastic. If you can balance all of those things, then I think you're hitting the mark. But anyway, guys, moving on to question number 4. This one was asked by Julio, who says, I'm beginning with a dividend growth investing strategy, and I have a question in mind every time. Is it better to have a small portfolio of, say, 15 to 20 stocks with a good amount of cash invested in each of them, or is it better to have a 25 to 30 stock portfolio with less money invested in each of them? So this is a really great question, and I personally think that less is more when you're first starting out. I don't think you need to have a ton of different individual stocks if you're just getting going as a brand new investor. Whether it's 15 to 20 or 25 to 30 stocks, I think that's going to be way too many to keep track of if you're just starting out, and I don't think you'll be able to have a high amount of confidence and conviction in each one of those right out of the gate. Instead, I'm a huge proponent for beginner investors just putting the bulk of their money right out of the gate into ETFs. I just think it simplifies the investing process so much. And I think that's something that you should try and do for yourself if you are just getting going, if you've never done this before. ETFs completely take the guesswork out of investing and gives you instant diversification, which is the benefit you'd be trying to get by owning those 25 to 30 individual stocks like you mentioned earlier. Now, with that said, if you're determined to own individual companies, which if you are, I understand, I personally like researching companies, and I like handpicking the stocks in my portfolio. So if you are dead set on doing something like that, then this is what I think the compromise is. Here's the happy medium. I think you still should put the great majority of your portfolio into ETFs. Like, for example, maybe put 70% of your portfolio into ETFs when you're first starting out. And then you can reserve the other 30% or so for individual stocks. And for an optimal setup, maybe consider starting out with like two different ETFs. You could pick some sort of broad-based ETF like VU, which would give you exposure to the S&P 500, or you could even go with a more growth-oriented ETF like SCHG. That's another very solid one, as well as a dividend growth-focused ETF like SCHD. I think some sort of combination between these types of ETFs should get the job done. Then, with most of your portfolio in the ETFs, which would create that diversification, you won't need to own 15 to 20 stocks or 20 to 30 stocks. From here, I think really all you need is like maximum 3 stocks, no more than 3. And the 3 companies that you choose should be ones that you think are like the strongest picks. Should be companies that you understand pretty well. And then you can use these as the starting point to learn how to research and analyze stocks. And with that said, if you're going to be investing in individual companies at all, you need to be willing to learn how to research individual companies. This means learning how to read financial statements and identifying what makes for a good investment. And in this next video right over here, I'm sharing with you my foolproof way to do exactly that. Here, I'll be sharing my simple 3-step formula for researching stocks. And this is going to help you develop an understanding of some of the essential things that you should be looking for, as well as some things that you should avoid. So click right over here to learn all about that, and I'll see you in the next one.